Morning, Chris. Thanks for joining me today for our March update of markets. I guess the big news in March was Credit Suisse, which happened at the beginning of the month. So maybe if we can have a quick chat and a recap about that and really how markets have dealt with it over the preceding weeks.
Sure, Adam. So Credit Suisse was effectively the next thing to go absent the US banks, and I mean market things sort of come in twos and threes. So our view is that the market was looking for some weakness in Europe after obviously weakness in the US banking system, and found that in Credit Suisse, which had been largely a basket case for many years, particularly on the equity side, and had been through multiple restructures and multiple CEOs. So market turned attention there. And similar to the Silicon Valley Bank story, in that credit was actually okay. It was a deposit run. So similar sort of story again, where deposits were being withdrawn at a much faster pace than Credit Suisse could cope with, and effectively was resolved very quickly. So Swiss National Bank and regulator effectively forced the company into UBS over a weekend, and had to change the rules along the way to allow for that sort of move, given Credit Suisse actually hadn't failed. So it wasn't a failed bank that then had to be shifted. It was it failing, and forced it into UBS with government support, central bank support, and some restrictions around trading going forward. So interesting move, sort of makes sense given the times, but very odd in the sense that the bank hadn't failed, but obviously a proactive reaction function from central bank and regulators to make sure that there was no extension of systemic risk or any sort of contagion.
And it appears that markets have obviously reacted quite well to it, because we obviously started the month with a fairly aggressive sell-off, or not right at the beginning of the month, but a few days into it. And we've had a very strong recovery afterwards, almost the opposite of last month. But I think really that's markets reacting, who have been reassured with the action with Credit Suisse.
Yeah, definitely. I mean, the reaction there is, I think the markets obviously always hope that central banks or regulators come and act early and fast. And it's not necessarily about what they say, but it's more about just giving markets something to trade on. So if they're clear and precise on what they're going to do and how they do it, then the markets can sort of move on from it. And I think that's given the market some comfort around moving on from it. So it seems like a bit of a distant memory, even though it didn't happen that long ago. But markets obviously traded positively off the back of it. And I think the other part of that is really to do with the fact that when you do have banks under pressure, it's likely that banks now will tighten lending standards and credit growth if they are under pressure from both the deposit side and a broader system side. So if banks are tightening credit conditions and credit standards, then they're doing some of the central bank's heavy lifting for them in terms of rising rates. So there's a prevailing view in markets now that maybe with those tighter financial conditions in the period ahead, that the central banks don't have to be as aggressive as they might have thought maybe a month ago, which is interesting.
I think we've certainly seen that in the way markets have moved in the certainly second half of the last few weeks of the month. We've had a very strong rally. Well, Nasdaq had a very strong month anyway, which we, as you've suggested, a growth function. I think Nasdaq was up 9.5% for the month, which is amazing, compared to the other indices.
Yeah, it is pretty incredible. I mean, obviously we've seen fairly significant sort of value growth gyrations in markets for the better part of 12, 18 months, and obviously tech versus non-tech sectors. And we saw that in January. I mean, tech and growth broadly rallied strongly in January, gave that back in sort of the second, third, and fourth week of February, and obviously fell earlier this month before rallying again. And that comes back to the fact that, I mean, obviously with growth stocks and technology stocks in particular, obviously they trade on higher PEs and higher valuation multiples. And if cash rates are done going up, that gives some clear line of sight for analysts when they're thinking about discounted cash flow modelling and valuations going forward, so they can be more clear on what sort of valuation multiples they ascribe to some of these faster growing companies. And I think that's given investors some comfort in relation to those particular names and stocks.
Now, we're talking about rates. Obviously, the Fed raised rates by 0.25%. But I think the consensus is that is still that these rate rises are likely coming to the end. What's your thoughts on that?
Yeah, the Fed raised rates 0.25, which was to be expected. I think there was some murmurings before the meeting that they may not raise rates because of the banking collapses in the US. I mean, the Fed's made pretty clear, and I mean, if you know the way the Fed operates, it's pretty clear that, I mean, rate rises, you don't not raise rates because banks are collapsing. That's a liquidity mechanism that you provide. So Fed's been very clear that rates are for inflation. And if they need to provide liquidity to banks, they'll do that via their balance sheet in terms of money printing. Which they did. So raising rates in March was, I mean, obviously needed in light of where inflation's at, but I think it was more for them to sort of make a statement that they're not going to use interest rates to sort of save banks or not save banks. So I think they raised there. What was critical, what the markets took out of the rate rise was more the statement, and then they released some projections off the back of the decision. And the projections they particularly had around their rate or their central forecast for where rates are going to end up, which is referred to their dot plot. They effectively, the median or the average of the committee members have only one more rate rise in for this year. So I think market's taken some comfort out of that. The market was also looking for when they might think they might cut rates. And the market has a bit of a sneaky suspicion they might be forced to cut rates sometime this year. But the Fed was pretty clear in both their statement and the dot plot that they have no rate cuts penciled in for this year. Now, that could obviously change. But I think markets took comfort in that they're probably at the back end of their rate hiking cycle, and that gave some further clarity to the forward period.
And closer to home, RBA, obviously, I think consensus is quite split on whether there's going to be a hold or another rate rise. I think it'll be this afternoon. But what's your thoughts on there at the moment?
I mean, we're at 360. I think most people had us sort of topping out at 385 or 4. So, I mean, you could argue there's probably a little bit more to go in that. But you're right, leading into this meeting. I mean, last meeting was very much 0.25 locked and loaded. This meeting it's very much split. So there's a lot of increasing rhetoric around the fact that they've probably already done too much, to be honest. And we do have the much talked about cliff in terms of fixed rate loans sort of coming up in May and June, where a large majority of the fixed rate loans in the market, mortgage loans, do come due for resetting or maturity. So there's some risk around what that sort of sets in play for the second half of the year. So, I mean, inflation's still high based on the last monthly inflation print we got, which is representative of the broader sample. So, I mean, given their inflation targeting bank, which they should be, our view is they still got ample room to lift rates if they want to, in terms of the mechanisms in which they go through it. But equally, I mean, we could make a case that they stand up at a lectern and say, we're still in rate tightening exercise, but we've just felt the need to pause this meeting and see how things play out. So they want to make sure they leave open the fact that they can still raise rates. I definitely don't think that they want to rate or send a message to markets that they're done raising rates. I think that'll be the last thing on their mind. So they're just got to be very careful how they sort of communicate a pause if today is a pause. So today I've got it at 50-50. They could go either way.
Okay, well, time will tell. We'll know the answer by the time this video goes out. Lovely. Thank you very much for your time, Chris. And we'll catch up next month.
No worries. Thank you.